Listen carefully, because what I'm about to tell you is happening right now, and most people have no idea. While you were celebrating the holidays, something extraordinary happened in the financial system. Banks quietly tapped the Federal Reserve for over $52 billion in emergency liquidity. And gold prices crashed 5% in a single day. This isn't a coincidence. This is a system-level event, and the connections between these two stories will blow your mind. By the end of this video, you'll understand why this matters more than any news headline you've seen this week. Let's dive in. The shocking numbers. What actually happened. Gold's dramatic reversal. On December 26, 2025, right after Christmas, gold hit an all-time record high of $4,556.30 per troy ounce. Silver simultaneously exploded to $84 per ounce, also shattering all previous records. But then something broke. Within 48 hours, gold plunged 5%, marking its biggest intraday drop since October 21st, and only the second time this year the precious metal crashed that hard in a single day. Silver was even more dramatic. It tumbled 11% in what became its largest intraday decline since September 2020. That's nearly 5 years ago. The iShares Silver Trust, SLV, the world's largest physically backed silver ETF, fell as much as 10%, its biggest drop since 2020. Think about that timeline for a second. The last time we saw moves like this was during the COVID-19 pandemic crash. What does that tell you? The hidden liquidity crisis. Now here's where it gets really interesting. Behind the scenes, while precious metals were crashing, the Federal Reserve was conducting massive emergency operations. The numbers. December 30th. The Fed injected $16 billion into the U.S. banking system through overnight repos. This was the second largest liquidity operation since the COVID-19 crisis. Total December injections. $40.32 billion through Treasury repos. But wait, there's more. Earlier reports indicated banks tapping $17 billion specifically tied to precious metals stress. Combined with other operations, $52+ billion in total emergency liquidity. According to bar chart, the December 30th operation ranked just behind pandemic-era emergency measures in size. Financial commentator Andrew Lokenauth noted this suggests everything is fine, but only on the surface. The connection. Why these events are related. Margin calls and forced liquidation. Here's what most people are missing. These two stories are directly connected. Chain reaction. Silver and gold surged to all-time highs during thin holiday trading. CME Group raises margin requirements. The second hike in just 2 weeks. Traders holding leveraged positions suddenly need more cash to maintain their positions. If they don't have it. Forced liquidation. They must sell immediately. As selling creates cascading pressure. More selling triggers more margin calls. Banks holding short positions face catastrophic losses. Banks tap the Fed's emergency repo window for liquidity. As one analyst put it, this is building into a flash crash, as investors who bought silver and gold on margin start facing margin calls, increasing the pressure to sell before their gains vanish. The Bear Stearns parallel. Here's the scary part that nobody is talking about. Silver took down Bear Stearns in 2008 with a much smaller move. Back in 2008, JPMorgan Chase acquired Bear Stearns after the investment bank collapsed. One of the contributing factors? Their enormous exposure to silver derivatives and precious metals positions. Today's situation is worse. Bigger position sizes, higher leverage ratios, less liquidity in the system. Weekend timing when markets are closed, one analyst wrote, with TBTF, too big to fail. Banks. Tapping the Fed's repo window for $17 billion in emergency liquidity. Friday, are we looking at Bear Stearns on steroids? Understanding the margin hike controversy. What are margins? Let me explain this simply because it's critical to understanding what happened. When you trade futures contracts, you don't pay the full value up front. You put down a margin, like a deposit or down payment. Example, silver contract worth $100,000. Margin requirement, $20,000, 20%. You control $100,000 with only $20,000 cash. This is 5-to-1 leverage. The CME's controversial decision. The Chicago Mercantile Exchange, CME, one of the world's largest commodity trading floors, made a shocking announcement. Margin increase details. March 2026, silver futures raised from $20,000 to $25,000, a 25% increase. This was the second margin hike in less than 14 days. Timing released. Friday, December 26th, right at the peak of the rally. What this means, If you were trading 10 silver contracts, before, need $200,000 in margin. After, need $250,000 in margin. Shortfall, must come up with $50,000 immediately, or sell multiply this across thousands of traders, and you get a tsunami of forced selling. The timing raises serious questions. According to CME Advisory number 25-393, this was released on Friday, December 26, 2025, with markets already reeling from the Christmas week surge where silver outperformed every other major asset class. Critics are asking, why now? The suspicious pattern: silver hits all-time highs, retail traders making massive profits, banks holding short positions facing catastrophic losses. Suddenly, margin requirements raised dramatically, forced selling, crashes the price. Banks get emergency Fed liquidity. Sound like manipulation to you? The bigger picture: bank reserves at crisis levels. The liquidity drain. Here's what the mainstream media isn't telling you. U.S. bank reserves have crashed to $2.8 trillion, their lowest level in 4 years. That's a decline of roughly $102 billion in recent weeks alone. On October 31st, earlier in the crisis, the Fed pumped $29.4 billion into the banking system through overnight repos. That was the largest liquidity injection in over 5 years. Since the early pandemic days when the financial system was on the brink, what are bank reserves? Bank reserves are essentially the cash that banks keep at the Federal Reserve. When reserves fall rapidly, liquidity dries up. Funding markets tighten, banks, especially smaller regional institutions, scramble for cash. Think of it like your personal emergency fund. If it drops from $10,000 to $3,000 in a few weeks, you know something is seriously wrong. The Fed is stealth pivot. Here's the most important part. The Fed has already announced they're ending their balance sheet runoff on December 1st. In Fed speak, that means we are stopping quantitative tightening because we can't afford to drain any more liquidity from the system. Translation: they're quietly backing away from their tough talk because they know the system can't handle it. Analysts are calling this stealth pivot, quiet bailout, QE light, or quantitative easing, the light version. Beyond repos, the Fed is not QE. Reserve management program could involve purchasing up to $220 billion in Treasury securities over the next 12 months to ensure ample reserves. $220 billion. Let that sink in. They say it's not QE, but if it walks like a duck and quacks like a duck, the September 2019. Parallel. History. Repeating the repo crisis. Nobody remembers. This isn't the first time we've witnessed emergency Fed interventions tied to liquidity stress. September 2019 repo market crisis. Overnight lending rates spiked. Unexpectedly. Shortage of bank reserves. Fed forced to intervene with immediate liquidity injections. Warning sign that something was deeply wrong. The crisis happened when everything was supposedly fine in the economy. Sound familiar? Fast forward to today. Same warning signs, same emergency interventions, same Fed assurances that everything is under control. But here's the difference. The numbers are much bigger now, and the system is much more fragile. Gold's role. Why this matters for precious metals. Gold is the canary in the coal mine. When central banks inject emergency liquidity, when bank reserves crash, when the financial system shows stress, gold should rally, not crash. So why did it dump 5%? The answer: forced liquidation cascades. When margin calls hit, traders sell everything. Profitable positions to raise cash, losing positions to cut losses. Even gold, the most safe haven, gets dumped. This creates a temporary price distortion. Gold crashes, not because its fundamentals change, but because of mechanical forced selling. Historical precedent. During the 2008 financial crisis, gold initially dropped alongside everything else as hedge funds were forced to liquidate. Then what happened? Gold soared from around $700 per ounce in late 2008 to over $1,900 per ounce by 2011. A 170% plus gain as the Fed printed trillions. Central banks are buying. Here's what should terrify politicians and wake up investors. Central banks around the world are buying gold at record levels, 1,000 plus tons per year in recent purchases. They're not buying more treasury bonds. They're diversifying away from dollar reserves. According to the data, the people who run the world's financial systems, the ones with access to all the data and all the inside information, are buying gold at record levels. They're preparing. J.P. Morgan's forecast. J.P. Morgan forecasts gold prices reaching $5,000 per ounce by late 2026, supported by central bank purchases, investor flows into gold ETFs, continued fiscal dominance dynamics, persistent inflation pressures. The fiscal dominance reality. The debt bomb. Nobody wants to discuss. The numbers that matter. U.S. national debt, approaching $36 trillion. Debt to GDP ratio, 118.78%. 10-year outlook, $50 trillion in Treasury debt projected rising government spending with no plan to pay for it. The dollar being challenged as the world's reserve currency. A central bank trapped between controlling inflation and preventing a financial crisis. Under fiscal dominance, inflation dynamics are more closely tied to government spending than to monetary tightening. This reinforces the appeal of real assets as a hedge against persistent fiscal imbalances. The unlocked liquidity debate. Here's something mind-blowing that just emerged. The U.S. Treasury's gold reserves, valued at $42.22 per ounce since 1973, now have a market valuation of over $1 trillion in 2025. The valuation gap. Official book value, $11 billion. Market value, $1 trillion. Potential unlocked liquidity, $760+ billion. Analysts are debating whether to revalue the gold to market prices, use it as collateral for borrowing, securitize it through gold-backed bonds. This could reshape how the U.S. manages its $36 trillion debt burden. What happens next? Expert predictions. The bull case, gold to 5,000 plus. Know why gold could explode. From here, emergency liquidity injections, weakened dollar purchasing power, bank reserve crisis, signals systemic fragility, central banks continuing to accumulate fiscal dominance, government spending driving inflation, geopolitical tensions remain elevated. The technical setup. Despite the recent crash, gold's long-term trend remains intact. 2024. Performance. Gold gained around 70% best annual performance since 1979. That's 46 years. Technical indicators suggest short-term consolidation before next leg up. As one analyst noted, gold's stellar performance in 2024 may leave it facing a near-term uphill struggle as technical indicators suggest it is overbought. That said, given that the longer-term trend is intact, it could present investors with the opportunity to engage at more attractive levels. The volatility warning. Mike McGlone, Bloomberg Intelligence. McGlone has been warning about this reversal, noting the last time gold and silver rose this quickly was in 1979, with prices peaking in 1980 and subsequently crashing. When it gets this stretched, be careful. The most important thing for people like me who have been bullish on gold forever is two words: take profits. The 1980 comparison. In 1980, silver hit $50 per ounce, about $200 in today's dollars. The Hunt brothers were trying to corner the market. Then, COMEX changed the rules, raised margins dramatically. Price crashed from $50 to under $10. Are we seeing history repeat? The likely scenario short-term, Q1 2025. Continued volatility as leveraged positions unwind gold, possibly consolidating $4,000 to $4,400. Range silver, $65 to $80 range with wild swings, medium term, 2025. As dust settles, strong fundamentals reassert Fed's QE light, provides liquidity support. Gold resumes march toward $5,000, long term, 2026 plus. $5,000 plus gold as fiscal dominance intensifies $100 plus silver as industrial demand meets supply deficit, potential two-tier market, paper versus physical prices. What this means for you. Practical implications. If you're an investor, the opportunity. This crash created a buying opportunity for those who understand the bigger picture. Fundamentals unchanged, in fact, strengthened by emergency Fed actions. Forced selling creates temporary price distortions. Long-term trajectory remains bullish. The strategy? Don't panic sell. This is mechanical liquidation, not fundamental weakness. Dollar cost average? Buy gradually on weakness. Physical over paper. Own actual metal, not just derivatives. Position sizing. Don't over-leverage. That's what caused this mess. Time horizon. Think 12 to 36 months, not 12 to 36 days. Risk management. Keep 5 to 10% of portfolio in precious metals. Mix physical holdings with liquid ETFs. Avoid leveraged positions unless you're a professional. Have dry powder, cash, to buy dips, if you're in traditional finance. Warning signs to monitor. Bank reserve levels. If they drop below $2.5 trillion, big trouble Fed repo operations. Sustained high usage signals, stressed treasury market. Watch the 10-year yield and move index. Dollar strength. Weakness could accelerate gold rally. The larger context, when the Fed has to inject $52+ billion in emergency liquidity, just to keep banks functioning, that tells you the system is more fragile than admitted. Paper assets depend on functioning financial plumbing. When that plumbing clogs, everything is at risk. But gold doesn't need the Fed. It doesn't need bank reserves. It just is. The bottom line. Connect the dots. Let me bring this all together because these connections are crucial. The sequence of events. Silver and gold explode to all-time highs during thin holiday trading. Banks with massive short positions face catastrophic losses. CME raises margins, forcing liquidation, cascading selling crashes, prices 5 to 11% in single day. Banks tap Fed for $17 billion in emergency precious metals related liquidity. Additional operations bring total to $52+ billion Fed, announces ending balance sheet runoff, and $220 billion not QE program. This isn't multiple unrelated events. This is one story. What it reveals? The financial system is running on fumes. Banks are over-leveraged in precious metals, shorts. Fed is trapped, must print or risk collapse. Traditional price discovery mechanisms are broken. We're in fiscal dominance, spending Trump's monetary policy. The historical echo. This feels like September 2019, repo crisis, meets March 2008, Bear Stearns, meets 1980, Hunt Brothers Silver. All three crises involved. Precious metals, volatility, emergency Fed interventions, changes to margin requirements. Banks in distress. The outcome? In each case, after the dust settled, gold soared. The crises revealed system weakness, and investors fled to real assets. Conclusion. What you need to know. The three key takeaways. The crash was mechanical, not fundamental. Gold and silver didn't crash because their bull market ended. They crashed because of forced liquidation from margin calls. The fundamentals, fiscal dominance, money printing, bank fragility, are stronger than ever. The $52 billion signals deep problems. When the Fed needs to inject this much emergency liquidity, it's not routine operations. It's a warning sign. Bank reserves at 4-year lows, repos at pandemic levels. This is stress. This creates opportunity. For investors who understand what's happening, this volatility creates entry points. The long-term trajectory for gold remains toward $5,000 plus as the fiscal situation deteriorates. Final thought. The people who run central banks with access to all the data are buying gold at record levels. They're preparing for what comes next.